Welcome to Lecture 2 of Value Investing in Growing Companies. I am Rachel, and I will take you through this lecture in which I will discuss the benefits of financial planning, why is it necessary to manage your money, and why is it best to make your own life decisions rather than seek advice from other brokers or advisory institutions. Also, please note that we would be discussing each instrument briefly. So let's begin. Financial planning is very important for your future. Consider this: if you had $10 in 1914 and you would have kept it in your pocket all these years, it would have shrunk to only 36 cents due to inflation. Hence, a little financial planning can help you make smart money and give returns far better than inflation. Now let's look some of the best possible instruments for financial planning. Insurance. Insurance is the first thing one should have. It includes accidental, health and life insurance. Do not confuse insurance with investments. We can talk about investments for some other time. Briefly speaking, there are 3 different kinds of insurance. First is accidental insurance. An accidental insurance, also referred as AD&D, is a policy that pays benefits to the beneficiary if the cause of death is an accident. This is a limited form of life insurance which is generally less expensive. The amount given to the beneficiary if accident takes place is many times more than average monthly salary. Second is health insurance, which is widely used worldwide. It is mostly provided by big corporate companies as benefits to their employees. If your company does not provide health insurance, you can find other insurance companies that offer these policies at very reasonable conditions. In many countries, health insurance is provided at good rates and policies. Health insurances help people by reimbursing the insurer for medical bills, injury or illness. Third is life insurance, which is the most common one. However, not every person needs this insurance in every stage in life. My personal view is, it is totally waste to put money at an early age and wait till it matures. The time period is as long as 10 to 20 years, with a very low return. We can look at other options to invest for such long periods where we can get better returns. It is a good news people are now getting familiar with other investments and getting rid of life insurance. Now let's look at my favorite part: the investment options. There are many investment options available for a common person, like debt instruments, which include fixed deposits and bonds, equity instruments, which include stocks and mutual funds, real estate, gold and other metals, currency in forex exchange, cryptocurrencies, and many more. Stocks. Since our whole course is on stock hunting, we would briefly talk about it here. When you invest in a stock, you become part owner of the company. Stocks represent ownership shares, also known as equity shares. Whether you make or lose money on a stock depends on the success or failure of the company, type of stock you own, and the events going on in the stock market, and many other factors. Stocks have consistently performed better than any other means of investment in long term. We would be looking at the stocks in detail later in our lectures. Bonds. A bond is a loan an investor makes to a corporation, government, federal agency, or other organization in exchange for interest payments over a specified term, plus repayment of principal at the bond's maturity date. There are a wide variety of bonds, including treasuries, agency bonds, corporate bonds, municipal bonds, and more. Bonds can be purchased as new offerings or on the secondary market, just like stocks. A bond's value can rise and fall based on a number of factors, the most important being the direction of interest rates. Bond prices move inversely with the direction of interest rates. When you invest in bonds and bond mutual funds, you face the risk that your investment might lose money, especially if you've bought an individual bond and want or need to sell it before it matures. Overall, the rate of return on a bond is quite low as compared to other means of investing. For example, the 10-year Treasury bond rate in US is only 2.2%. Mutual funds. Mutual funds are a popular way to invest in securities. Because mutual funds can offer built-in diversification and professional management, they offer certain advantages over purchasing individual stocks and bonds. But Like investing in any security, investing in a mutual fund involves certain risks, including the possibility that you may lose money. Mutual funds are valued at the end of each trading day, and any transactions to buy or sell mutual funds are based on a valuation matrix called net asset value, also called NAV, which is calculated by performance of the mutual fund. Mutual funds can make distributions in the form of dividends, interest, and capital gains. These distributions will be taxable if held in a non-retirement account. Selling a mutual fund can result in a gain or loss on the investment, just as with individual stocks or bonds. It is also to be noted there are various different kinds of mutual funds which invest in different instruments. For example, the equity mutual funds invest in stock market, the money market invests in bank deposits, and fund of funds mutual funds invest in different mutual funds altogether. These mutual funds have their own limitations and restrictions according to the mutual fund laws of their respective countries. ETFs. ETFs, or exchange-traded funds, are like mutual funds, but are traded on the stock exchange during the trading day just like shares of stock. An ETF, or exchange-traded funds, is a marketable security that tracks an index, commodity, bond, or the group of assets like the index fund. Unlike mutual funds, which are valued at the end of each trading day, ETFs are valued constantly while the markets are open. ETFs typically have higher daily liquidity and lower fees than mutual fund shares, making them an attractive alternative for individual investors. Real estate and REITs. Real estate investments can be made by buying a commercial or residential property directly. Real estate investment trusts, REITs, pool investors' money and purchase properties. REITs are traded like stocks. There are various mutual funds and ETFs that invest in REITs as well. Any investor who is keen in investing in real estate can directly buy the land, or in case of less capital can invest his share of capital in REITs that collectively invest in the real estate market. Gold, currency, and other alternative investments. Gold, silver, and other precious metals can be traded in physical format or from exchanges through mutual funds and future contracts. On the other hand, currency can also be traded in forex exchange. All these investment options vary on different parameters and factors in the market. There might be several other alternative investment ways like hedge funds, cryptocurrencies, 401k plans, annuities, etc., but one should focus on a few investment options in order to save time and effort. We should always divide our investments among these different investment options. This is called asset allocation. Amount of money which should be put in each asset class differs from person to person. For each person, asset allocation changes at different stages of life. Intelligent investors focus on maintaining asset allocation because it helps them diversify their portfolio. In this way, an investor can have a balanced portfolio and might sit peacefully while his income grows in different instruments. This brings an end to our second lecture. In the next lecture, I will introduce to you Father of Value Investing, Benjamin Graham, and we will also look at the different types of investment principles mentioned by Graham. Furthermore, we will be looking at his famous book, The Intelligent Investor, and his key takeaways from the book. Till then, stay blessed and happy investing.